all participants because I'm trying to cover all topics in approximately 45 minutes. Then 15 or 10 minutes, we will try to make a brainstorming about what can be your question about the topics here. So as I said, we will try to cover the global macro outlook for the 2024 and the expectation and challenges. Our presentation is like this one today. And as you see, I want to slowly cover this side in what can be done in the macro outlook in the 2024. As you see, the global economy has outperformed even our optimistic expectation. GDP growth is on the track beat consensus forecast from a year ago for the US especially. Why? Because as you know, after the interest rate hike, the global economy is slowing down and the soft landing in the economic activities and the GDP growth. For that reason, GDP growth forecast is downside for the global economies with the leadership of the United States. And secondly, more disinflation is in store over the next year. What does this mean? As you know, after the COVID crisis, the central bank first decreased the interest rate and the second started to rise with the global tapering process. The interest rate hikes started to deal with and to fight with the inflation. And yesterday, as you see, the Federal Open Market Committee maintained its policy rate in a 5.5, no change, and give a small signal to there will be a cut in 2024 3 times. What does this mean? The interest rate decision, right, of actually cut or hike in each side can be adjusted according to inflation outlook. For that reason, today with this right and high interest rate, really high point of view in approximately, as I said, 5.5 policy rate today in the United States, the inflation start to go down from 9% to 3% today. And they are saying that with this tight monetary policy stance, the disinflation, meaning that decrease in inflation, will continue in 2024 as well. Although the normalization of the product and labor market is now well advanced, its full disinflation is still playing out, and core inflation should fall back to approximately 2.5 by the end of the 2024. What does this mean? Some items out of the control of the monetary policy can be still high, but the core inflation will be in the band of the Federal Reserve target rate. So 2 and 2.5 is the Fed target rate for the inflation outlook. And for this reason, there will be no need to maintain this high interest rate environment, and we can decrease the interest rate. And we continue to see the only limited recession risk, and we affirm 15% recession probability. By the way, when you will see in the next couple of slides, the recessionary probability in the beginning of the year today, this year, is approximately 80% for the United States. Why? The market expecting that if Federal Reserve continue its tight monetary policy stance like this, the market will enter the recessionary period. But now, today, with the market outlook, we can directly say that the only 15% recession probability can be seen in the United States. So there will be no fear, no consideration for the recessionary probability in the United States. And also global growth will be really good for household income and a smaller drag for the momentum and monetary and fiscal tightening and the recovery in manufacturing activity. Why manufacturing activity is important? Because it is directly a real market indicator, and if manufacturing activity, manufacturing PMI, Purchasing Manager Index, manufacturing production, if go down, this means that market can enter a recessionary period. But today we can say that the manufacturing activity not will go down, but it will be in the recovery period. And increase in the willingness of the central banks to deliver the insurance cost of if growth slows, meaning that if growth go down, we can even decrease the interest rate more than the market expectation. So we can adjust our interest rate policy according to growth, employment, and inflation outlook. And the most major developed market central banks are likely finishing the hiking. What does this mean? Not just the Federal Reserve, but also the European Central Bank, Bank of England, and the Bank of Japan also stopping their interest rate hike process, meaning the quantitative tapering will also be end in the near soon, and the rate cut process for the all global and developed market economies will be started sooner. Then rate cut probably won't arrive up to 2024 second half. What does this mean? Yes, there will be a rate cut, but this rate cut will follow if we see a disinflation in the market economies. For that reason, according to the projection and forecasting of the global central banks, the inflation will not decrease as they expected until the first half of the 2024. For that reason, the rate cut process can only be started after the second half of the 2024. And when rates ultimately to the settle, we expect central banks to lower the policy rates above their current estimates of long-run sustainable levels. What does this mean? We mean that the interest rate decreasing will be better than the market expectation. So this inflation also will be covered by the all global economies, manufacturing activity, positive supply side shocks will come to the market. With the low demand side, the disinflation period will be quicker than expected. And let's look at the Bank of Japan side. The Bank of Japan will likely start moving to exit yield curve control in the spring before formally exiting and raising the interest rate in second half of 2012. Why? Because the Bank of Japan, the Central Bank of Japan, will focusing on the yield curve shape according to their monetary policy. And if the yield curve long end will rise up, this means that inflation expectation is going up as well. And we will continue our tight monetary policy stance. But today, we see that in the longer term yields, even in the Japan, the longer term yields is going down. For that reason, the exit from the yield curve monitoring will also stop in the second half of the 2024 for the Japanese economy as well. And the market outlook is complicated by compressed risk premium and the markets that are quite well priced for our central case. We expect return in rates, credit, equities, and commodities to exceed cash in 2024 under our baseline forecast. What does this mean? We expect return in rates, credit, equities, and commodities to exceed the cash, meaning that today, in 2023, the cash return is really high because policy rate is approximately 5.5 and the deposit rate is approximately 6% in the United States. But this deposit rate return, cash return, will decrease in the next couple of months because the central bank will also cut the rates and the return in rates, credit, stock exchange, equities will be higher than the return of the cash in the 2024. For that reason, you can start the position in the commodity or equity market for higher return than the cash. And the last point here, the transition to a higher interest rate environment has been bumpy, but investors now face the prospect of much better forward return on fixed income asset. Why? If the fixed income interest rate is high, the price is going down. So if the yield curve going up, meaning that if you take a position in yield curve and if the rate is going up, you will lose the money. But today, our expectation is that 2-year or 10-year treasury yield will go down. And if you take a position the price will be go up and you will get a return and positive profit here. The big question is whether a return to the pre-global financial crisis rate backdrop is an equilibrium. The answer is more likely to be yes in the United States than elsewhere, especially in Europe, where the sovereign stress might reemerge. What does this mean? The global financial economy is recovering better in the United States, but because the Europe is a production economy, the recovery process will be a little bit come with a lag effect and slows down. For that reason, if you take a position in the companies in the United States, their performance can be better than the performance of the companies in the European region. Let's look at the slides and the charts right now. For the macro outlook 2024, the hard part is over. Why? Because while you are increasing the interest rate, first the market adjustment process will start, and all prudential investors change their position from the commodities, stock exchange, fixed income to the cash. Why? Because you know that the interest rate hike will bring a good opportunity for the cash return rather than the financial market assets. For that reason, that part is over now. As you see in the Exhibit 1, growth has outperformed in our optimistic expectation in 2023. Look at the left-hand side chart. It is starting from the 2022 until the 2024, and the worst case for the global economy's growth outlook is in the end of the 2023, and this will be the bottom line. And from here, we will start to a recovery process for the growth in the global economies. And as you see here, I have a forecast for, look at this one, forecast for the global economic outlook. And from here, as you see, we are still in the bottom line for the forecast, and the forecast saying that at least the global economies will growing in the end of the year 2024 approximately 2.5%. And today the growth is just 0.5. For that reason, the growth outlook will converge its pre-pandemic level. As you see here, as Exhibit 1 shows, we now estimate that global economy will grow 2.7% this year, above the Bloomberg consensus forecast of 1 year ago. And 2.5 is our pre-pandemic level. Please look at the chart in the second presentation and slide. And as you see, by the way, please look at which type of indicators we are looking for. Here, we will first focus on the GDP growth. As you see, the GDP growth, our first macro indicator. And secondly, we will focus on the unemployment rate. And the unemployment rate has settled below the pre-pandemic levels. Look at it here. When the COVID-19 started, it's 2020 March. And with the start of the pandemic, the United States or the global unemployment rate rise from approximately 6% to 10% in just 3 months. Then the global central banks take measures with the quantitative easing period, and until here, even we are better than the pre-pandemic level in unemployment rate. And the global central banks, while taking decision in interest rate decision-making process, they are focusing on GDP, employment condition, and the price inflation. For that reason, these three indicators should directly can change their monetary policy stance in global markets. As you see, these positive surprises came despite several unexpected negative shocks. Think this, when you are starting the quantitative easing period, there is no Ukraine and Russian war. There is no Israel and Hamas war. There is no additional shock. But despite those Russia-Ukraine war, despite Israel-Hamas war, despite lots of global challenges, we are still here, better than the expected. And this is really good. First, both short-term and long-term interest rate rose significantly further than the implied by market pricing, partly due to the better than expected growth data, but also partly due to the more hawkish central bank reaction function. Hawkish monetary policy stance will directly decrease the inflation, but the employment conditions still better off. With this rise in the interest rate, normally the unemployment rate should rise, but Federal Reserve still outperform in the unemployment rate. And in the second slide, what we say directly here, GDP, our first. Unemployment is our second. And now we are focusing on the price inflation. And in Exhibit 3, a sharp drop in core inflation across the economies that saw a post-pandemic surge. And look at it here. Normally, the core inflation is around just 2%. Okay. Then the core inflation during the pandemic decreased to approximately zero lower bound because there is no demand in the market. Then the global central banks started the quantitative easing period to start an inflationary outlook, and inflation starts here, then take a pick up here because of the Russian-Ukraine war shocks, and we will approximately experience the 7% in the global inflation outlook. But today, with the tight monetary policy stance, we are converging to 3%. And there will be no interest rate cut until the March of 2024. And until the 3 months past, this inflation outlook will converge to 2%, which is the target rate of the Federal Reserve today. And please look at the explanation here. To demonstrate the size of the improvement, Exhibit 3 plots the average core CPI inflation rate for all G10 economies minus Japan, because Japan is an outlier. There's no inflation there. For that reason, we want to take into consideration where we faced high inflation economies, and plus the EM, early hiker economies that experienced the biggest inflation, because in emerging market economies, we have higher inflation than developed market, and they start the interest hike process, and they are more hawkish than the Federal Reserve. Today, just think that I'm in Turkey. Today, the policy rate in United States is just 5.5, but in Turkey, it is 40. I'm not joking. It is 40, meaning that 8 times higher than the United States policy rate. Why? Because the inflation in Turkey is approximately 65%. For that reason, to fight with the inflation effectively and to bring the price stability in the market, the central banks all around the world, maybe the emerging market economies, should be more hawkish because of their risk premium. But today, as I say, we will face at least 3 months more hawkish and tight monetary policy stance as well. Since the end of the June, please look at the sentence. Since the end of the June 2022, sequential core inflation in this group of economies has fallen from 6 to 3. This is dramatic, and this is really good while dealing with the inflation, because from 6% to 3% is not easy to decrease the price inflation, because this is year-over-year performance. Central banks have therefore achieved more than 3/4 of the adjustment needed to get that inflation to back target. Meaning, normally, even the central banks, while they are building up their monetary policy stance, they are also not expecting a good inflation outlook like this, and not expecting a disinflation process so fast. But today, they achieved this, and for that reason, they stopped the interest rate hike process. They are focusing and they are just monitoring the market challenges and developments. According to those challenges, they will adjust their monetary policy stance again by cutting the interest rate if the projection is as they expected. And here, I want to show you in Exhibit 4, the core inflation has declined meaningfully everywhere. Please look at the countries here. By the way, during the cycle, this whole bar showing where we reached during the pandemic and post-pandemic. Then the blue line showing where is today we are. And the Sweden, UK, Norway, Canada, and New Zealand, Australia, Euro area, US, and the Switzerland. As you see, even in Sweden, the inflation reached approximately 11%, but today we are in 4%. And for the UK, for instance, it is 10%, but today it is around 4%. And for the United States, as you see here, today we are here just in 3%, but we experienced 7% inflation after the pandemic level. And here you will see the emerging market economies, which faced higher inflation and more hawkish monetary policy stance. As you see, the Hungary, 30% inflation, Czech Republic, 20%, Romania, 20%, Poland, 15%, Chile, 15%, Colombia, 15%, Brazil, approximately 14%, Mexico, 12%, and we have Peru, approximately 12%. When we compare these emerging market economies with these developed market economies, those are really have a spread between their inflation environment, because as you see, the highest one in the developed market is just 10%, but even the lowest one higher than 10% in emerging market. As I say, the emerging market economies have more risk premium and volatile capital flow according to the negative and positive shocks in the monetary policy. And the improvement is widespread across economies. The Exhibit 4 shows that every economy in our group of 10G and the emerging market has seen a very meaningful inflation decline from the peak. If you see the peak and what is we are today here, the dealing with the inflation, the central banks are really successful. And please look at this projection and forecasting chart about the monetary policy outlook. First, try to understand what is being represented here. As you see, this is category inflation rate quarter ago, and the rate is annualized. This is the density function. I mean, how the distribution of the inflation bends across the mean, and the distribution of price increases, developed market economies. And as you see here, this is GDP weighted average, meaning this price inflation and distribution is also GDP weighted. And 2017 and 19, the average is approximately here. The quarter peak of inflation rate is today here with the purple, and the blue is the current third quarter of 2023. And today, if we look at what has been achieved, the improvement is also brought across the price index components. Exhibit 5 shows that the right of the tail of the distribution of price changes, which captures the big price increase, has shifted part away back towards its pre-pandemic position, although it has not fully normalized because of catch-up moves in lagging areas where prices are set relatively infrequently in healthcare and insurance sector. Why does this mean? We are trying to explain here that this inflation distribution is not normal distribution, right? It is long left tail or right tail. And today, with this not normally and equally distributed, not symmetric distribution, we achieved better than the market expectation today, and we converge our current outlook like the quarter of peak inflation rate, and we are less than the 2017 and 2019 average inflation probability density. And one of the most important chart here. In this chart, we are trying to summarize the goods disinflation still has to further to run. Please look at what we have here. The blue line showing the manufacturing activities inflation, and it is in the right hand side, and the core goods inflation with the red line represented in the left hand side. As you see, the highest point for the good inflation is 10%, while the manufacturing PMI is approximately just for the 4.5% for the peak level. But today we are here, meaning that the PMI index, look at the PMI index. PMI meaning that manufacturing index, manufacturing PMI, the threshold value is 50. If you are above the 50, it is good. Market is expanding, market condition is good. If you are above the 50, as you see, we are above the 50 for pre-pandemic level, but during approximately 3 years, there is no good in the purchasing manager index. There is no order, there is no supply for the global economies. But today, as you see, the global market PMI indices is above the 50. This scale is reversed. Okay, left hand side is inverted version. So from here to here, we are increasing, and from 50 to 60 in the purchasing manager index. But what is not good and a challenge for us, it is for the inflation for the core goods. What can I say here? Core goods inflation not in line with our expectation. Goods market still has a higher inflation today. As you see, we experienced a peak in the 6%. Today we are around the 2.5%, but maybe until the end of 2025, we can decrease the inflation in goods market just to 0%. And this is the last mile for us. We don't think the last mile of disinflation will be particularly hard. First, although the improvement in supply-demand balance in goods sector, measured, for example, by suppliers' delivery lags, is now largely completed, and the impact on core goods disinflation is still unfolding and will likely continue through the most of 2024. Today, we are not in the point what we want in the core goods inflation, but with the 2024, we will achieve this as well. I think in the chat side, I suppose there's a question, but no. Okay, I'm proceeding. It is just chat. And in Exhibit 7, as you see, shelter cost inflation has further to fall. Please look at the pandemic level of the shelter inflation. As you see in all developed market economies, blue is United States, red is the Euro area, the gray line is the United Kingdom, the light blue is Canada, and the green is Australia. And the shelter inflation is really high. But with the quantitative tapering period, shelter inflation is also starting to down, but it is smooth, not going down like the core goods inflation. Look at the core goods inflation, how it is decreasing. It is sharp. But in shelter inflation, we are a little bit smooth decline, not sharp. And at the right-hand side, please look at the country's shelter contribution to the sequential headline inflation, meaning that how the shelter inflation contributed to overall inflation in that economies. And here we are in Canada, Australia, United States, United Kingdom, and Euro area. The cycle peg is the red bar. The latest one is the blue one, dark blue. At the end of 2024, with expectation, this light blue we will achieve, and the achieve for the previous 3 years is the gray line. Look at the gray line. In any case, the gray line is less than the 2024 end, meaning that whatever we achieve, even until the end of the 2024, we couldn't reach the point for the 3 years ago's average in shelter inflation, even for the next year. Meaning that shelter inflation need also a little bit patience from the market participant to go down. Goods inflation going down sharply, but shelter inflation is not. And even in the 2024, it is above the previous 3 years average. Shelter inflation has considerably further to fall. This is true across developed market economies, although the size of the impact is smaller in the Euro area and the UK, where owner-occupied housing is excluded from the K inflation measures. It is because of the calculation effect. And here we are, the Exhibit 8, showing the labor market is easing as job openings fall without higher unemployment. What does this mean? This means that, look at the left-hand side chart first. As you see here on the left-hand side, we have a black line. This is GDP weighted average. And for the US, Euro area, United Kingdom, Canada, and Australia, we have change in jobs workers gap since the December 2019, meaning that just before the COVID-19 start. And we are looking the change in the jobs worker gap, meaning search and matching, how much job I have at hand and how many workers looking for that job. I'm looking for the spread, searching and matching. And here, as you see it during the COVID crisis, we have a huge gap. As you see, because if this job worker gap is widening in the minus side, meaning that I have no job, but I have lots of workers looking for the job and unemployment going up. And here I'm in minus period. But today, as you see, I have more jobs than the workers I have at hand, and I have job openings more than the workers for the looking for that. For that reason, unemployment rate decreasing considerably in the developed market economies, especially during the 2023. And in the right-hand side of the chart, the developed market economies, excluding Japan beverage curve, I should also give the definition of the beverage curve. Beverage curve is showing the correlation between the unemployment rate and the job opening rate. Okay, you can think this as what is the unemployment rate and job opening rate in these economies. And the beverage curve, because we are excluding the Japan, as we said, the Japan is an outlier in developed market economies according to inflation and unemployment rate condition. And this blue, dark blue line and the dots showing before peak in job opening rates. This is December 2019. And today we have here, meaning that, look at it, unemployment rate decreasing and job opening is increasing. So we are really good in employment market condition if we exclude the Japan from the developed market economies. So there should be no need to think and to take into consideration of the employment market condition today. What should be in mind and should be deal with and can become a challenge for the next year? It will be the biggest inflationary environment that is coming from the unexpected shocks. Why? Because we have projection today for shelter, goods, energy inflation. But with this projection, core goods declining sharply, shelter declining smoothly, and if this inflation is going down, unemployment will rise up in somewhere. But today, employment market condition is good. So until this inflationary environment come to our targeted band, there is no need to fear about the employment market condition today. And this Exhibit 9, sequential wage growth is slowing everywhere. What does this mean? Normally, because of the inflation, for instance, in Dr. Lambert, when they take a promotion or wage increase, they will always ask that, what will be the inflation for the next year? Because my purchasing power will decrease because of this inflation with my current wage. For that reason, I need an increase in my wage because of the inflation. And with the highest inflation environment, wage growth increasing to not to suffer from the loss of inflation and purchasing power of my wage. But today, wage growth decreasing because the inflation is going down. There should be no need to increase our wage more because inflation will go down in next couple of months. And here, as you see, the sequential wage growth today is just around 5 and 77.5%, but they experienced approximately 20% because in these economies, after the COVID-19 crisis, we faced approximately 20% inflation, and all households and the workers requesting from their employer that I need at least 20% increase in my wage to not to suffer from the inflation. And today, core inflation, as you see, should cool to below the target consistency level by end of 2024. And on the left-hand side, left chart, I have percentage year ago, the measured developed market economies core inflationary environment. And today, after the peak, as we say it here, please keep this word in mind, the hard part is over. Okay, the hard part is over. What does this mean? The hard part is here. Hard part. The peak in the inflation. And it is in 2023. And we passed this. Today, the hard part is over. The next class, next job, next duties for the central banks will be a little bit easier. But they are still prudential because they don't know which type of negative or positive demand and supply side shocks they can be faced during the 2024 as well. So, as I said, they are prudential still, but hard part is over. Okay, the next one is easiest part. Today, if we look at the projection, the inflation will be converged and will be smooth in the 2% of the targeted band. And in the right-hand side, as you see, aggregate of the G10 economies, excluding Japan, early hikers for the inflation outlook. Look at this one. We faced the 7% of the hike, the highest point. And today, until the end of 2026, we will converge to the 2% targeted level for the inflation of the economies. The upshot from this discussion is that the last year disinflation does indeed have further to run, meaning that, yes, during the 2023, we are good in disinflation period, but we have more ways to complete. On average, across the G10, excluding the Japan and the EM early hikers, we expect a slowdown in sequential core inflation from 3% now to the 2.5 range that will be the broadly consistent with the inflation target. Look at this one. We are here 3%, but we are still above the targeted band. So we will pave the way until the inflation will decrease to our targeted band of 2.5%. If anything, we think that the risk to the achievement of the target consistent inflation are on the earlier side. Okay, inflation will converge if there is no additional supply or demand side shock in the market economies. And the last slides for today is this. Please look at the recessionary environment and probability here. What I said here at the beginning of the slide, look at it here. We continue to see only limited recession with the 15% for the United States economy. And if you look at this Exhibit 11, we have become more confident that US economy will avoid the recession. And as you see in the match of the 2024, what is the probability of recession? Approximately 60%, meaning that market pricing that United States will face with the probability of 60% a recession in 2023. But today, this recession forecast decreased approximately just the 15% according to, for instance, Goldman Sachs. The market still fearing about with the 50% of the recession probability. And as I say, please look at the explanation here. Despite the good news on growth and inflation in 2023, concerns about the recession among forecasters have not declined much. They are still 6%. Even in the United States, which has outperformed so early, so clearly on growth in the past, Exhibit 11 shows that the median forecaster still estimates a probability of recession with 50%. That the recession will start in next 12 months. This is down only modest from the 65%, only decreased from 65%, but the Goldman Sachs, one of the best forecaster and investment banking in the world, they are saying that no need to fear the recession. And in Turkey, we also making a forecast for the recessionary environment for the global economies, and there is still no need to fear about the recessionary environment because Fed will monitor the recession indicators in the market so closely, and they will take necessary action and measures to deal with recession like they fight with inflation as well. So today what we directly covered here, we tried to cover that after the global financial crisis that we faced with the pandemic period, the global market economy started a quantitative easing period. They started to increase the inflation and decrease the interest rate. When the market economies converge their pre-pandemic level according to their economic activities, then inflation rise up above the expectation and targeted level. From that point, the central banks started tapering period, meaning the reverse action of the quantitative easing. Now they started the interest rate increase and wait for the disinflation and decrease in the inflation in the economies. But while the inflation decreasing, GDP will decrease as well and unemployment increase. So this decrease in inflation should be compatible and adjusted according to employment and economic activities in the market. For that reason, today, until the Fed increased the interest rate 5.5, they stopped there. During 3 months, they are still constant, and they give a signal that they will decrease the interest rate to trigger the economic activity in the global economy again, because the GDP growth forecast today for the next 3 years below the 2% approximately, and this is not good for the economic activity. Yes, you can stop the inflation, but economic activity should continue as well. For that reason, they will prudential about the interest rate increase for further. In the next couple of months, they will start to decrease the interest rate to bring back the GDP growth in their long-term average. This is the end of my slide.